You right? Well, ladies and gentlemen, the Treasurer and I have called this news conference to comment upon and take any questions on the decision of the Reserve Bank this morning to lift the official cash rate by 0.25%. I am aware, and the government is aware, that this decision will hurt some home buyers, and we're very conscious of that, and it will have an impact on some household budgets. That is all the more reason that we were very pleased that we had a sufficiently strong budget position to provide tax relief and other benefits to families in the recent budget, which was the 5th budget in a row where the government was able to provide taxation relief whilst still retaining a very strong fiscal surplus, establish the future fund, complete the payment of the debt obligations incurred by former governments. What this decision by the Reserve Bank does is to place economic management once again front and centre in the political and social debate in this country. It's a reminder of the balancing act that good economic management represents. It's a reminder that even in a strong economy there are pressures and challenges which, if not properly managed, can undermine the fundamental strength of the economy. There is nothing in today's decision which suggests that the economy is weakening. Rather, the very strength of the economy is identified by the Governor as the principal reason why there are pressures necessitating this interest rate adjustment. We should, of course, keeping it in perspective, remind ourselves that housing rates at present, after the increase, will still be lower than they were at any time under the former government, and the average housing interest rate under the former government of 12.75% is a full 4.5 percentage points higher than what the housing rate will be as a result of today's increase. I think the other comment I would make before inviting the Treasurer to make some comments and put the issue into economic perspective is to say that the worst possible thing any government could do at the present time is to embrace a policy that would put upward pressure on inflation and therefore on interest rates. And I think particularly of the Labor's intention, if it wins government, to dismantle our industrial relations reforms that will, by re-establishing a centralised wage fixing system, lead to a wages breakout in areas of the economy that can't afford wage increases, with negative consequences not only for employment but also for higher inflation and through that higher interest rates. Changing industrial relations will put upward pressure on interest rates. It will be a fundamental policy reversal that will be bad for the economy and bad for interest rate settings. Treasurer.
Thanks. Thank you very much, John. As you know, this morning the Reserve Bank moved in the market to increase the official cash rate by 0.25% to 6.5%. The statement released by the bank made it clear that the reason why it increased the official cash rate was the domestic economic demand has signalled a pickup in the pace of growth. That is, that the economy is strengthening. It noted that there are international factors at play at the moment which have given turbulence on stock markets, particularly developments in the United States, but looked through those to see a strengthening Australian economy. The official cash rate of 6.5% is lower than it was when this government was elected, and that is after 11 years of growth and 2.1 million new jobs. The fact that after the longest continuous expansion in Australian history and 2.1 million jobs, the official cash rate is still lower than it was when the government was elected indicates the distance that we have travelled since 1996 and the improvement in economic fundamentals. As the Prime Minister said, the standard variable mortgage rate, which you would expect if this is passed on in full to be 8.3%, is lower than the standard variable mortgage rate at any time under the previous government, is lower than it was at any time during the previous government, and is about 4.5% lower. This rate is about 4.5% lower than the average that it was over the complete period of the previous Labor government. One of the things that is working very much in Australia's favour at the moment is an increase in the terms of trade. The prices we are getting for our export compared to the prices that we are paying for our imports has improved markedly. That is bringing a lot more money into the country. In previous terms of trade booms, by this stage we would be in double-digit inflation. The fact that our inflation will still be consistent with our target of 2 to 3% over the course of the cycle indicates how much stronger we are today. And I just want to echo what the Prime Minister has said. Nothing could be worse than to go back to the old industrial relations system, which would pass on the income from this terms of trade boost right throughout the Australian economy, set off inflation and bring about the inevitable punitive interest rate correction. That is the risk of Labor. Labor's risk is to go back to an industrial relations system that let us down in the past and will not allow us to cope with the future.